Warren Buffett is one of the world's richest people, consistently ranking high on Forbes' list of billionaires. His net worth was listed at $80 billion as of October 2020. Buffett is known as a businessman and philanthropist, but he's probably best known for being one of the world's most successful investors. This is why it's not surprising that Warren Buffett's investment strategy has reached mythical proportions. Buffett follows several important tenets and an investment philosophy that is widely followed around the globe. So, just what are the secrets to his success? Buying a stock is probably the easiest part of the investment process. Once you've found an opportunity and done all the due diligence that you believe is required to establish whether or not the company is undervalued, clicking buy at the right price does not take much effort. It is much more challenging to decide when to sell. You may have a game plan when you first enter a position, but there's no guarantee that the situation will remain the same throughout the duration of the trade. The situation will likely change over time, and you have to be prepared to adapt to this. The Oracle of Omaha takes a pragmatic approach to investment decisions. Before handing over any money, Buffett lays out the facts about the company he's interested in. You have to be able to play out your hand under all circumstances, he told shareholders in 2006. But if you can play out your hand, and you've got the right facts, and you're reasoned by yourself, and you let the market serve you and not instruct you, you can't miss. And although Buffett controls investments worth billions of dollars, nearly anyone can copy his tactics. Back in February, Warren Buffett's Berkshire Hathaway revealed that it sold 9.81 million shares of Apple at the end of 2020. Speaking during the conglomerate's annual shareholder meeting, however, Buffett acknowledged that this decision was probably a mistake. In February, Buffett explained that Berkshire sold a small portion of its Apple stake at the end of 2020, pocketing $11 billion. Because of Apple's share buybacks, however, which reduced the total number of outstanding shares, Berkshire's ownership of Apple actually increased to 5.4% despite that sale. Apple represents Berkshire's biggest common stock investment. Buffett follows the Benjamin Graham school of value investing. Value investors look for securities with prices that are unjustifiably low based on their intrinsic worth. There isn't a universally accepted way to determine intrinsic worth, but it's most often estimated by analyzing a company's fundamentals. Like bargain hunters, the value investor searches for stocks believed to be undervalued by the market, or stocks that are valuable but not recognized by the majority of other buyers. Buffett takes this value investing approach to another level. Many value investors do not support the efficient market hypothesis, EMH. This theory suggests that stocks always trade at their fair value, which makes it harder for investors to either buy stocks that are undervalued or sell them at inflated prices. They do trust that the market will eventually start to favor those quality stocks that were, for a time, undervalued. If something's important but unknowable, forget it, he says. I mean, it may be important whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. Focus on the variables that you do have at your disposal. Once you've narrowed down your information, then you decide whether you have information of sufficient value that, compared to the price and all that, will cause you to act, Buffett explains. Whether or not you choose to invest in something should be based on your research, not on your reaction to what other people are doing and saying. As Buffett puts it, what others are doing means nothing. That's why Buffett recommends doing your homework beforehand and investing in solid companies that will last, rather than trying to time the market or react to your anxieties. Concentrate on the facts, not how you're feeling. Don't watch the market closely, he told CNBC in 2016 amid wild fluctuations. If they're trying to buy and sell stocks and worry when they go down a little bit and think they should maybe sell them when they go up, they're not going to have very good results. When it comes to deciding when to sell securities, Warren Buffett, Trade's portfolio, has an elementary rule. He makes sure he buys only stocks that he will never need to sell. That way, he never has to answer the question. Well, the best thing to do is buy a stock that you don't ever want to sell, is how the Oracle of Omaha replied to one audience member at the 1998 Berkshire Hathaway annual meeting of shareholders, who asked him if he could outline the criteria Berkshire uses to decide when to sell a stock. But planning this way can only get you so far. which is what Buffett went on to acknowledge. Another reason why you might want to sell a stock is that a better opportunity comes along, he said. In this situation, it is perfectly acceptable to turn your back on a stock you want to hold forever. Here's what Buffett had to say on the matter at the 1998 meeting. Sometimes, if we need money to move to another sector like we did last year, we will trim some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses or we wouldn't own them. And we would sell if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. And it went on to be worth 100 or more times before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do anything else, so you sell if you need the money for something else. Buffett typically considers only companies that have been around for at least 10 years. As a result, most of the technology companies that have had their initial public offering, or IPOs, in the past decade wouldn't get on Buffett's radar. He said he doesn't understand the mechanics behind many of today's technology companies and only invests in a business that he fully understands. Value investing requires identifying companies that have stood the test of time but are currently undervalued. Never underestimate the value of historical performance. This demonstrates the company's ability or inability to increase shareholder value. Do keep in mind, however, that a stock's past performance does not guarantee future performance. The value investor's job is to determine how well the company can perform as it did in the past. Determining this is inherently tricky, but evidently Buffett is very good at it. One important point to remember about public companies is that the Securities and Exchange Commission, SEC, requires that they file regular financial statements. These documents can help you analyze important company data, including current and past performance, so you can make important investment decisions. The debt-to-equity ratio, D/E, is another key characteristic Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowed money. The D/E ratio is calculated as follows. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. This ratio shows the proportion of equity and debt the company uses to finance its assets, and the higher the ratio, the more debt rather than equity is financing the company. A high debt level compared to equity can result in volatile earnings and large interest expenses. For a more stringent test, investors sometimes use only long-term debt instead of total liabilities in the calculation above. He looks at each company as a whole, so he chooses stocks solely based on their overall potential as a company. Holding these stocks as a long-term play, Buffett doesn't seek capital gain, but ownership in quality companies extremely capable of generating earnings. When Buffett invests in a company, he isn't concerned with whether the market will eventually recognize its worth. He is concerned with how well that company can make money as a business. When he handed the microphone on to Charlie Munger, Trade's portfolio, the vice president of the Berkshire added that the ideal time to sell a stock is when you found something you like immensely better. The main takeaway from this commentary is that investors should be looking to find stocks that they don't need to sell in the first place. That way, they never have to deal with the difficult question of when to sell. If you own something you never intend to sell, you only need to consider exiting when you've found something better. What is your opinion about Warren Buffett? Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Hit the bell icon for more updates and notifications. Stay safe, and we will be back soon with another video.